Dear friends, welcome to the March edition of Monthly Viewpoints. The month gone by has been very eventful. It started with the Union Budget implementing LTCG on equity and equity-oriented funds, an introduction of dividend distribution tax on equity-oriented funds. It was a little negative for the domestic markets. Added to that, good macro data points in the US, particularly the average hourly earnings, which came in at 2.9%, which was 30 basis points above the previous print, spooked the markets, and along with it, the volatility index has spiked up. There is a general expectation in the market that Fed would raise rate hikes faster than what was anticipated before. It seems like the concoction of bad news has been hitting the markets throughout the month. The large cap index Nifty closed 4.9% below its previous level, and we've also seen that the mid cap indices and small cap indices have fallen more than large cap indices at 5.2% and 5.4% respectively. All sectors, barring any sector, has closed in the red for the month. Among the global peers, the performance of Indian markets were bottom of the pack in USD terms during the month. The rupee had depreciated by 2.5%, which contributed to the underperformance of equity markets as well. And we've also seen that the bond yields on 10-year have backtracked by 30 basis points to 7.73%. And in the US also, because of scare of inflation coming back, the bond yields have gone up by 16 basis points. But quite interestingly, the German Bund 10-year has decreased by about 4 basis points. After being driven by the foreign ETF flows in the month of January, the month of February have seen that the FPI is pulling out of the market, and they pulled out close to about $1.9 billion. The domestic has provided support. They have put in about $275 million, out of which $200 million came in from mutual funds alone. On the data front, GDP came in at 7.2% for quarter 3 of this fiscal year, which was good because of increased net indirect tax collections which we had. But GVA number is the one which we should look at, which came in at 6.7%, which was okay, primarily driven by agriculture and manufacturing. The IIP number was also decent at 7.1%, primarily driven by capital and consumer non-durable segments. We've also seen that the CPI has come down by 14 basis points to 5.07%, driven by lower food article prices, but the core inflation remained flat at 5.2%. On the earnings front, the Nifty companies put up a good show for quarter 3 of fiscal 18, with PAT growth of about 12.7%, EBITDA growth of about 16%. If there were no negative surprises in some of the PSU banks as well as some of the global auto majors, the numbers could have been still better. Coming to the view. Last year, we've seen that the mutual fund industry has received 250,000 crores of money, and this money has seen steady increase in returns over the last 12 to 14 months. The month of February has proven that equity markets are prone to gyrations. It is important to note that investors are rewarded with higher returns if they tide over these gyrations and invest over a prolonged period of time. We have been highlighting that the markets would adjust to the new reality of increased capital gains tax, weakening domestic macro on the margin but improving micro, global trade war but strong global macro data points, and questioning of political continuity. As investors for long term, set your eyes on the goals, rebalance your portfolios to have the right combination of equity with a large cap tilt, and make volatility your friend, and to invest more on bad days. If your return expectations are between 12 to 13% in a 3-year time frame, I think one should not be disappointed. And we have a whole host of funds to offer you across various baskets. We have the Frontline Equity Fund, the Top 100 Fund in the large cap space. We have the Advantage Fund and Equity Fund in the multi-cap space. We have the MNC Fund from a quality point of view. We have Tax Relief 96 from a ELS's tax saving point of view. And also, if somebody is looking for low volatility funds, we have Balanced 95 Fund. We have the Balanced Advantage Fund, which is run on a PE model. And we have the Equity Savings Fund, which has 30 to 35% of equity component in it. Coming to the fixed income point of view, the RBI in the recent policy mentioned that the first half of fiscal year 2019 would see a higher inflation, but the second half could see a lower inflation. The market today, with a term spread of 175 basis points, the 10-year yield minus the repo rate, is indicating a multi-year high, and is also indicating that there could be 2 or 3 rate hikes in the offering, which seems to be an aggressive proposition from the markets. And we also see that there's some technicality playing out wherein the PSU banks have not been buying in the GSEF market. In RBI, which normally does OMOs to manage prices, has not been doing so. So those investors who want to play the higher yields available from a duration point of view can feel free to do so using our income fund or gilt fund. For those investors who do not want volatility and want to play higher yields, could come into our corporate bond fund and medium term plan. And there are other short term maturity funds which are playing accrual, namely short term opportunities fund and cash manager fund. Thank you and happy investing.